Tyler is 35 years old, standing in a homeowner's driveway, phone in hand, staring at a commission statement that says he made over six figures last year and a bank account that says otherwise. Now, if you're sitting there thinking, I've been doing this for years, I earned good money, and I still have nothing to show for it, then that thought is exactly why you're right here now. Here's what nobody's telling you. Starting at 35 with zero saved is not the same thing as being behind forever. The math on a commission income actually has a feature most W-2 earners don't get. The upside swings are real, and a single structured year can close a gap that took a decade to open. Most reps in this spot keep waiting for the right month to start. February is slow, so they wait. Then storm season hits, and the money comes fast and goes faster. Then it's December again, and nothing has changed. That's not bad luck. That's a loop. By the end of this video, you'll know exactly whether your situation is actually salvageable, what the realistic timeline looks like starting from zero at age 35 on commission income, and the first move that actually changes the math. Over the years, I've watched reps in this exact same spot, mid-30s, good income, nothing in the account, talking themselves into one more season before they get serious. I've seen what that costs them, not in theory, in real outcomes, real marriages, real retirement dates that kept moving to the right. So let's get into the actual numbers and answer the question straight. Tyler is not an outlier. He is the pattern. He closed a strong year. He knows what a good commission check feels like. He also knows what it feels like to watch that check dissolve into a truck payment, a credit card minimum, a slow February, and a wife who stopped asking where the money went because she already knows the answer is nowhere good. At 35, with zero in a brokerage account and zero in a Roth IRA, he is not unusual. He is the median roofing sales rep at year 4 or 5. The thing that makes Tyler's situation feel desperate is the same thing that makes it fixable. He has been earning real money, he just has not kept any of it. That is a structure problem, not an income problem. Here's what that actual picture looks like. Tyler grosses somewhere between $100,000 and $160,000 in a good year. After self-employment tax, after the truck, after the insurance, after the slow months where he floated the household on a credit card, somewhere between $40,000 and $60,000 actually touched his checking account in any meaningful way. He spent it all, not on one big stupid thing, on 100 small things that each felt reasonable at the time. That is the setup. That is where we start. Here's the question Tyler is actually asking himself when he says, am I screwed? He's not asking about math. He's asking about permission. Permission to believe the window is still open. So let me answer it directly. No, Tyler is not screwed. But the next 12 months matter more than the last 5 years combined. Here's why. At age 35, Tyler has 30 years until his standard retirement age at 65. If he opens a Roth IRA today and contributes the 2026 maximum of $7,500 and does that every single year until age 65 and earns a conservative 7% average return, he ends up with just over $708,000 in that account alone. Tax-free. That is one account. That's not counting a SEP or IRA, which Tyler qualifies for as a 1099 earner. Now here's an important detail most videos gloss over. While the SEP technically allows up to 25% of compensation, the actual effective rate for self-employed earners works out closer to 20% of net income after the IRS self-employment tax adjustment. On a year where Tyler nets 80 grand from his roofing work, that roughly works out to $14,000 to $16,000 in SEP contributions on top of the Roth. And the 2026 cap on the SEP is $72,000, so there's serious room to grow as his income climbs. Run those numbers with a tax professional who actually understands self-employment income, because the exact figure depends on how his books are structured. But here's the point. Roth plus SEP starting at age 35, contributing aggressively through his peak earning years. That number at 65, not embarrassing. It is real. But here's the turn. The reason Tyler has not done this is not ignorance. He has heard of a Roth IRA. He's heard of a SEP. He's not done it because he has no system that survives a slow month. Every time he tries to save, February shows up, or a hailstorm misses his territory, or a deal falls out of the pipeline at week 6, and the money he meant to invest is already gone because it was sitting in the same checking account he pays his bills from. That's the loop from the hook. February is slow, so he waits. Storm season hits and the money comes fast and goes faster. December again, nothing changed. The turnaround is this. The system has to come before the savings, not a budget, a structure, separate accounts, predetermined rules for what happens the moment a commission hits. The money has to be allocated before Tyler's brain gets involved, because Tyler's brain is very good at finding reasons why this month is the exception. Here's the realistic timeline, and this is the only version that is actually useful. Year 1, Tyler's only job is to stop the bleeding and build the structure. He opens a Roth IRA at, let's say, Fidelity or Vanguard this week, not next month, this week. He opens a SEP IRA the same day. He sets up a separate savings account and names it tax reserve because he's almost certainly under withholding right now, and a surprise tax bill in April will wipe out everything he tries to build. He contributes whatever he can to the Roth before December 31st, even if it's $2,000, even if it's $1,000. The account being open and funded changes his identity. He's now someone who invests. That matters more than the dollar amount in year 1. Year 2, the system is running. He knows his conservative baseline, meaning the monthly number his household needs to survive a genuinely bad month, not an average month. He allocates every commission check the moment it lands. 20% to taxes before anything else. A fixed amount to the Roth and SEP before he sees the rest. The remainder goes to operating expenses. This is the feast system. Forecasting, expense management, allocation first, selective budgeting, and time optimization. It is not complicated. It's just predetermined. By year 5, Tyler's 40. He has 5 years of compounding behind him. He has a Roth IRA with real money in it. He has a SEP that's starting to look like an actual retirement account. He hasn't caught up to the guy who started at 22, but he's not screwed either. He's building. And he's doing it on commission income, which means his ceiling is real. The guy who waited until 40 to start this conversation, he's going to be sitting in a driveway at age 40 asking the same question Tyler's asking at 35. And the answer will still be no, you are not screwed, but the math gets a little harder every year you wait. Tyler's 35. The window's open. The question is whether he walks through it this week or talks himself into one more season. Hey Roofing Money Pros, if this video helped you, be sure to hit the subscribe button right now because this is the only channel that's actually talking about money specifically for roofing sales reps. There's a lot of general financial advice out there, but it doesn't account for variable income, commissions, and the way this industry actually works from someone who's worked in it. Go grab the Feast or Famine Survival Guide at the link below. It's the starting point. It's free and it will show you the first move. Thanks for watching, and in the meantime, keep stacking, keep building, and I'll see you in the next one.